Well, we were talking about the Reserve Bank being the first central bank to pause interest rate hikes, but New Zealand, as we're saying, took no chances with inflation. It jacked up rates by another 0.5% today, taking its cash rate to 5.25%, the highest in 15 years. Jess Maggio.
It's another rate hike from the Reserve Bank of New Zealand, but economists predict the interest rate should start to steady from now on. On Wednesday, the RBNZ raised the OCR a further 50 basis points, bringing it up from 4.75 to 5.25%. The 11th successive hike takes the rate to its highest level since December 2008. Financial markets have always expected the rate to be lifted around the 5% mark. However, some economists predict it could reach as high as 5.5% by mid-year. While Australia left its cash rate unchanged at 3.6%, New Zealanders have been warned to lower expectations of rate cuts. Economists predict there may not be any until mid-2024. The past 8 rate rises have been 50 basis point increases, barring the October to November massive spike of 2022 of 75 basis points. The RBNZ says the decision followed concerns a smaller hike may have resulted in mortgage rates falling. New Zealand's inflation rate remains at 7.2%. The Reserve Bank of New Zealand is taking a hard stance to bring it back down to between 1% and 3%. Business confidence remains historically low at around 66%, despite bouncing back very slightly in the first quarter. That would suggest the aggressive rate hikes are having an impact on consumer spending, which has decreased to rein in inflation. New Zealand is likely to enter recession very soon, if not already be in the early stages, and that is only going to be exacerbated by the Auckland floods and Cyclone Gabrielle. In their statement, the Reserve Bank of New Zealand said over the medium term, the committee anticipates economic activity to be supported by rebuilding efforts in the aftermath of the weather events. The demand on resources is expected to add to inflation pressure by more than assumed in the February monetary policy statement. There is a lot of pressure at the moment on households. Mortgage rates are rapidly rising. Food costs are at a 32-year high. House prices are declining. And of course, household bills are steadily increasing. So no sign of immediate pressure yet, and it's not likely to come until later this year.